Good morning, everybody. I'm Tunja Kali, Marketing and Training Manager at Duquesne University SBDC. Thank you for joining us today. This has been a really long year, and we still have 2 more weeks. Today, we're going to talk about tax planning and with everything going on with the EIDL and PPP loans and the pandemic. We will just want to give you some idea about tax implications of these programs, of these loan programs, and also we will talk about some tips to improve your cash flow in 2021. We have 2 experts from Wilkie and Associates, Greg and Omar, will be teaching the webinar today. A couple of things about the logistics. If you have any questions during the presentation, feel free to type them in chat. We will try to answer, and also we will have time at the end to answer all your questions. We have a big group of people today, so we may not be able to answer all your questions in chat, but we will definitely have some time at the end so you can unmute yourself and ask your questions. And lastly, we will email the slide deck and the recording of the webinar later today. So this session is being recorded and we will email the slides and the recording. Okay, Greg. Let's get started.
Good morning. Are we ready? Good morning, everyone. We're going to cover, as well as in addition to tax strategies and some regulatory changes and different programs that occurred over the past year, just some lessons we've learned from the pandemic and things you can do as business leaders, business owners, or business managers or participants as you head into 2021, which will hopefully be a more enjoyable year for many of us. I want to share a little bit of a background on myself. Yeah, I started my career a long time ago. We'll just say a long time ago as a CPA. I spent many years, some years in public accounting, then some time as a CFO, and over a decade as a CEO. So I've run a business, grew that business from about 10 million to 40 million in revenue with about 300 employees, and really went through a lot of changes and saw a lot of good times, bad times, challenging times, saw competitors thrive and saw competitors go out of business, and learned an awful lot about planning, finance, strategy, and business execution. What I do now for Wilkie and Associates is I help businesses be better, if you will. I help them understand how to be more profitable, how to improve their cash flow, look at their business strategies, work with management training, compensation strategies, helping prepare financial projections, putting business plans together, and in a lot of ways helping professionalize businesses, both small and large. And also another large part is helping businesses obtain the appropriate types of financing and capital sources, and a lot with mergers and acquisitions. So if you're looking to buy or sell a company, I'll largely be involved. Omar is a tax manager with us. Omar, I'll let you go ahead and introduce yourself and share a little bit about your background.
Thanks, Greg. My name's Omar Thrower, and I am a tax manager here at Wilkie and Associates. I've been in the business for roughly, I'd say 20 years or so, working in the accounting CPA world. My primary emphasis at this time is tax, but I have been more of a generalist over the years. I started my career out as a generalist, helping clients with payroll and budgeting and accounting. I did some audits and things of that nature. Maybe about 5 years in, I began to focus on the tax end of it, which is very exciting. It's been really exciting over the last 10 years. And I really do, my favorite part of my job is helping my clients understand all the complex tax rules, regulations, and issues that are floating out there. So I work with businesses, mainly small businesses, some mid-sized businesses, and occasionally a very large business as well. And my primary focus is on what we call flow-through entities. Those would be your S corps and partnerships And I also do work with the owners of those businesses as well. So a large part of my practice involves tax planning, not only for the business, as well as tax planning for the owners of those businesses as their flow-throughs. I also work with some C corporations as well, and some trusts and estates as well. So happy to be here and looking forward to sharing with you guys here later after Greg finishes. Greg?
Yeah. I can just get this. There we go. So this is kind of the list of topics, and the first 5 large bullets I'll cover. Omar will cover the end. We'll go through a lot of these kind of quickly. I know it's kind of a little bit of an eclectic list of topics here, and we hope it gives you some some of this guidance and items to think about as you lead and manage your business in the future from a financial and operational perspective. The impact of 2020, I've been in business for over 30 years and really have seen an awful lot of change. 9/11 was a huge change. There's been technology changes. And every year you say there's been a lot of changes when you reflect on the past. But I have to say there's no doubt 2020 will be hopefully the largest amount of change I think I see in my career in any given year. When you think about this past year, the amount of time that schools were closed, that parents suddenly became teachers, daycares were closed, vacations were canceled, travels dropped to still less than 20% of what it was, pre-pandemic. Weddings have been canceled, sporting events were canceled, and toilet paper and Clorox wipes became gold. I don't think we ever really thought this was possible. But through this, while it's been a year like no other, there are many businesses that have thrived. And there are also many businesses that unfortunately have closed. And almost every business has changed during this past year, and every industry has changed, and some have changed forever. We're not going back. The strongest and most adaptable companies have fared better, and part of that is the best capitalized companies have fared better as well.
Voice no problem है check voice auto check नहीं.
If you guys on the call, if you can put yourselves on mute there, please. But I think one of the biggest changes we'll see from 2020 is the implementation of technology that's been pulled forward. There are businesses that had plans to do things 5 or 10 years from now that did them this year. And that's not going to change. That has been accelerated forever. And people's attitudes has changed. People have learned a lot about themselves. They've learned about what's important to them. Their values have changed. Their interactions with people have changed. Their purchasing methods and timelines have changed. So an awful lot has changed, and we need to look at the environment as we plan our businesses moving forward. Also during the year, the government stepped in. They put PPP loans in place, which many are familiar with, enhanced unemployment benefits. They put bans on foreclosures, other new regulations, and lots of tax changes that Omar will cover. Historically, I believe maybe at times the 9 scariest words in the English language are, I'm from the government and I'm here to help. But I think in 2020, the government did a lot of things right. They did a lot of things that positively impacted businesses. They stepped in, they saved a lot of jobs, they saved a lot of businesses, they saved in a large respect the economy in connection with the business world and the adaptability of businesses themselves. So what did we learn from the pandemic? Without a doubt, plan for the unexpected, be ready to pivot, be ready to change. Think about the worst case scenarios. Remember this, business is never as good as it looks, and it's never as bad as it looks. And that happens all the time. When you think things are as good as it gets and it's going to stay that way forever, it's probably going to turn. And when you think things are really bad, it's probably not quite as bad as it looks. Most importantly, and a lesson I learned from my mom, save for a rainy day. Make sure your business is well capitalized. And we'll touch on that at the end here. So before we go into too much about how your business has changed, I want to talk about a couple of the government programs that were put in place. The PPP, we're going to focus on the loan forgiveness side of it. If your company received a PPP loan in 2020, that loan can be forgiven if you spend the money on employee wages.
Greg, your voice is fading sometimes.
Oh, I'm sorry. Is that better?
Maybe if you get closer, yeah.
Sure, absolutely. Thank you. So if you received a PPP loan, a lot of the questions we're getting today is the companies that want to make sure their loan is properly forgiven and they can get as much of the loan forgiven as possible. And most of our clients are seeing 100% forgiveness. And a lot of this information's out there, but if you spent the money on employee salaries, benefits, taxes, rent, mortgage interest, or utilities, based on a series of complicated calculations, your PPP loan will likely be forgiven. You have 24 months from the time of receiving that loan to spend that money on the approved items. Now, that forgiven amount will be reduced if there's been changes to your employee headcount, wages, or the number of hours your employees were working. As I said, the calculations can get complicated. I think the best website I've seen for details is the US Treasury website. Go there, it's easy to find stuff, it's well organized, and you'll have access to the most accurate and most timely up-to-date information. And if you need help, by all means, work with a CPA firm or a bank, get some assistance on this. There's a lot of money out there, and there are some pitfalls. The Families First Coronavirus Response Act was an act that was passed to assist workers who might be affected from the coronavirus. And this has probably received a little less publicity, and maybe your company's well aware of it, maybe they're not. But essentially what it does is it requires additional benefits through 2020, and we believe this is likely to be extended beyond this year. If an employee can't work for any COVID-related reason, they're likely entitled to some additional compensation. So what is that? There's two components to it. First is the emergency sick leave. So this is something impacting the employee personally. If they're required to quarantine, if they've been advised from a healthcare provider to quarantine, or they're experiencing COVID symptoms, and they can't work and can't telework for these reasons, you are required to pay them 100% of their pay for up to 10 days, up to a maximum of $511 a day, a little over $5,000 over 10 days. This is a requirement. Now, the second part of the act deals with emergency family medical leave. And this impacts employees who can't work or telework because they're caring for someone who is essentially impacted by COVID for some reason, whether they need to quarantine or a family member needs to quarantine or a child can't attend daycare or school. In this case, the employee is eligible for up to 2/3 of their pay to a maximum of $200 per day. Very important. All payments under this act are eligible for a tax credit, 100% tax credit. And Omar can talk more about this. It's not a tax deduction, it's a tax credit. So really this is being funded by the federal government. But you need to code things appropriately with your payroll providers to make sure you receive that credit. So there are two of the major regulatory items that have impacted a lot of businesses this year. So looking at a post-pandemic world, it's been the longest 2 weeks of my life. I don't know about yours, but the end is coming, and we need to be prepared for what happens. You know, and it's time to ask ourselves some questions as business owners, business leaders. You know, what have you learned this past year? What part of your business goes back to normal if there is a normal? And what doesn't go back? What has really a new normal moving forward? Have your customer expectations changed because of this pandemic? And the answer is probably yes for most of you. Have your employee expectations changed? I will share that my guess is most employees' expectations have changed, and we'll talk about that a little bit.
Greg, we still lose your voice.
Oh, I'm sorry.
So
Is this better again?
Yeah, that's better. Let me turn off your video. Maybe your connection gets better.
Sure.
So let's try that.
Okay. Is this okay? Can you hear me?
Yeah, now it sounds good.
Okay.
Yes. Much better.
So another lesson we've learned in 2020 is make sure you have enough bandwidth to do more things virtually. But these are some questions we should be asking ourselves in a post-pandemic world. Again, have your customer expectations changed? Have your employee expectations changed? What practices do you want to keep? It's really time to evaluate everything you do. People, processes, your products, your cost structures, absolutely everything. And how do you do this? A lot of it's really through some hard work and being honest with yourself. And it's harder to do alone. It's important to get some help and some additional perspective as you try to answer these questions and how they're going to impact your business moving forward. There are some things that have changed forever. Some of the things we're seeing, business travel has changed forever. No doubt about it. Video conferencing, what we're doing today here, has changed forever. We think the real estate industry has changed forever. The desire for remote work and the ability for people to work remotely has likely changed forever. Technology and adoption and expectations have changed. Even what's acceptable business attire. Generally, now Omar has a tie on today, but I don't, and most of us don't. And while that environment was changing prior to the pandemic, it really has changed subsequent to the pandemic. And we don't think they go back. The education industry has changed. How we consume entertainment has changed. Most businesses will be impacted either directly or indirectly. So when you look at a post-pandemic world, thinking about the people you work with, no matter what business you're in, you are in the people business. Employees have been stressed, they've been frustrated, they've been scared, they've been through a lot this year. We need to reflect this in our expectations of employees. But it's a great time to assess the value of your team. Who has shined, who has shown adaptivity, and who can you not live without moving forward? And consequently, who did you think you could live without, but maybe isn't as needed today? You need to put a plan in place to retain your best people. Because when the world opens up, there's going to be opportunities for these people to move around. There has been an apprehension for people to make career changes during this pandemic. When that changes, there is some demand for great employees that will open up, and there are desires for those employees to maybe make some changes. We need to make sure we retain our best people. The trend of working from anywhere is accelerated. The best people will demand they can work when, where, and how they want. And to a large extent, people have done that during the past year and feel it has been somewhat successful. that genie's not going back in the bottle. So things you need to think about are how can you accommodate this workforce? What policies do you have that need to change? And how can you keep and maintain the best talent? So looking beyond people, looking at your products and services, questions we're encouraging our businesses to ask themselves as they move forward. Which services will see increased or decreased demand? Should you be changing or adding or maybe eliminating some services? And are you staffed to accommodate the changing demands? One of the things I do a lot with businesses is working with business owners to improve their profitability. And one of the questions I often ask is, where are you making money? How much are you making on different services? And be surprised how many either don't know the answer or really get it wrong when you dig into it. It's a great time to reflect on and spend some time trying to understand your different products and your service offerings. You can understand your direct costs, your indirect costs. That includes selling time and delivery time and expenses. And understanding your prices of your services in the market. Spend a lot of time with companies and this year that's changed more than anything. And I think next year you'll see some more changes as well. A big part of this is your cost structure. Businesses have spent money in areas they never imagined, and they spend a lot less money in other areas. All businesses typically want to minimize their expenses. One of the best practices we're working with our clients for today is to go through every expense line item on your financial statement, on your income statement. Compare it to prior years. Take a look at what's higher and what is lower. And really take a look at how that has impacted your ability to deliver your goods or services. Every company should be going through this process today. It's incredibly, incredibly valuable. We're spending a lot of time with our clients going through this. Look at expenses. Can you reduce costs and become more expensive? Some examples. Can you reduce travel time? It saves time and money. Make your staff more productive. Can you reduce your office space? There's a lot of business owners that are somewhat frustrated paying for office space that is set idle most of the year. We have businesses that are starting to pay people that are planning on paying people to work remotely in the future. They know it saves the company potentially rent, utilities, furniture costs, food, coffee, other incidentals that are in the office. It can be harder to manage, but there's also less sick time involved for people that work remotely. There's studies that have been done that prove this. So it's really time to ask yourself as a business leader, should I be considering these things? And if you're not, are your customers doing this, and how will that impact your business? Take a look at how you can reduce your payroll with technology efficiencies. Again, go through every single expense item in your financial statements. It's a time to look at your business strategy too moving forward. Do you have a plan? Many companies we work with have plans and many don't. The best thing about not having a plan is you won't know if you fail. Spend some time and put together a roadmap for the next few years, at least for 2021. This can be a one-day process. It can occur over several weeks or months. It really depends on the size and complexity of your business. Our advice is to use an experienced consultant in this area to help lead and facilitate the process, and get your plans in writing. Review your strategy, review your plans on a monthly basis. Get help preparing for the future. Again, whether that's internal or external, your strategies, there is value in getting other perspectives, an awful lot of value. We mentioned at the beginning that the well-capitalized businesses have fared better for the most part, and the old saying is cash in king is king. There's many different sources of capital. The best one really depends on your business and your personal needs. Right now, money is as cheap as it will ever be. The worst time to try to look for financing is when you need it. This past year, the government did step forward with the PPP and EIDL loans when needed, but that was because of a global pandemic. When an environment changes that isn't global in nature, the government typically will not be there for a backstop. So it's a good time to kind of shore up your balance sheet and take a look at your cash and your capital structure. There's lots of sources. We work with all of these: banks, credit unions, receivable factoring. Sale leaseback transactions is something we're starting to see a lot of. With low interest rates and low cap rates on real estate, we're seeing it's probably the best time in the last 30 years to unlock the value, the equity in your real estate. You will get the largest value for it and the lowest lease prices moving forward. And there's lots of companies, private equity groups that are in this business. There's vendor financing, there's private equity, friends and family. There's crowd lending. There's a company called Honeycomb that we're working with a lot and referring a lot of our clients to. And this isn't crowdfunding, this is crowd lending, where groups of individuals come in and all lend a small amount to a company. It can be a small business. There's coffee shops looking to get new equipment and dog groomers trying to buy vans and some larger businesses as well. And you can generally borrow up to $1 million through some of these crowd lending sites. The interest rates are typically higher, but it's an interesting avenue for capital. And finally, SBA loans. We've probably, 40 or 50 clients probably in the last 6 months alone that we've helped prepare and obtain different SBA loans for the businesses. So again, it's a great time to take a look at your capital structure, to shore up your balance sheet, and maybe go out there and look for some different financing options. That's that's kind of the end of what I have here. I'm not seeing chat questions. I don't know if they're in there. So if there's any questions, we can open up now or throw it over to Omar to go through some of the tax stuff that maybe is more interesting. Hopefully this provided some kind of insight and made you think about some things and some questions that you'll need to answer as you look at 2021. Again, we're seeing lots of businesses kind of doing some soul searching and really enjoy working with them and helping them plan for the future. So I will stop my screen share at this point and open it up to questions and to Omar. I'm not sure if I've stopped my screen sharing or not.
Yes, you stopped, Greg. Do you have any questions for Greg? Feel free to unmute yourself and ask your questions.
Yes, hi, good morning, Greg. Thank you so much for making yourself available today. I was telling Tunka that I appreciate it. It's a great topic because as small businesses either prepare for their taxes or prepare for closure, nonetheless, they still have to be able to report what their earnings were. So the question I have is what you had stated in your last slide as it relates to the crowd lending. You said honeycomb.
Yes.
Could you put that information in the chat box, like a website or a link so that we can go to? Because I'm already thinking of 2 clients that could possibly benefit from this type of lending opportunity.
Yeah, absolutely. I'll put that in there. We've probably referred, interestingly enough, probably at least 10 clients in the last, 3 months or so.
10 clients?
Yeah, probably. We've referred that I'm
Okay.
aware of in the last 3 months. And there's, we have 50 professionals in our firm. I'm sure there's more than that I'm not aware of, and some may be working with them that didn't go through us. But absolutely, I'll put a link in the comments here.
Thank you. I appreciate it. I think for the most part, I'm just looking forward to the Zoom link and the slides so I could share as well some of this information with other clients that could benefit from this information, especially when it relates to the loan forgiveness for the PPP. That was important. And then talking about the US Treasury's website has probably the most accurate and up-to-date information for small businesses that have actually gone through the PPP loan process and need to know about the process to get some of those funds forgiven, because he says it's complicated.
It is complicated, and I've found it. The beginning of the year, we were all, kind of running on a treadmill trying to find information, and the information obviously kept changing, and there's sites out there that haven't updated their information, and it's kind of impossible. And if you go to that site, it really is. It's well organized, and you can see the history of it and what's current. It's without a doubt the best site to go to. So
Okay.
glad that's helpful.
Yes, I know you placed that link, that hyperlink in
I
your
did.
slide. That's why, yes.
Yep.
Mhm. No, thank you again, and happy holidays.
My pleasure. Same to you.
Greg, we have a question in chat.
Okay.
So Jason asked, is Honeycomb mainly friends and family donors, or is it broadcast for the public to get involved?
So it works. They actually will do both. It's open to the public. So as a matter of fact, I can go on there, and I've looked at some where I don't know the company, I don't know the people, but you go on there and you tell your story. The company tells its story, and I can go ahead and say, I'm going to lend this company $500. They might be looking for $100,000. So I could go on there. I don't need to know the company. I don't need to know the people. So it is open to the public, but one of their strategies is to reach out to your friends and family, as well as maybe your customers if you're an existing business. And so it is kind of both, but it is open to the public, and they handle all the administrative stuff. So if you have 100 different people that lend to you, you make one monthly payment to Honeycomb, and they in turn pay each sublender their proportionate share of their interest and principal repayment.
Okay, thanks, Greg. Any other questions?
Yes, I have a question. My name is Donna Walsh. In regards to the Family Care Leave Act, if you were a small business owner, which I am, one person, no employees, and I were to go down, are there any benefits for me in regards to getting paid, or any type of subsidy for myself as being the business owner and not the employee?
That's a great question, and one I don't have an answer to. I will try to find that out and put that in the chat afterwards here by the end. I don't know that answer, and I haven't been asked that question. We know on the PPP loans, there are different rules for business owners and different amounts. In some cases, kind of, I'll say, lesser benefits than
Yes.
employee benefits, right? My instinct is no.
That's what I figured. And here's the question. Here's another question that I had in the beginning when all the loans were coming out. I'm in the real estate business, so I don't have any contractors or anybody coming to my jobs doing the work. Consequently, I'm not a business if they can't show.
Right.
But I am not a brick and mortar, business. So it's very hard for me, or it's been very hard for me to find funds for that loss.
Yeah, that is definitely a challenge, and we're seeing that with several of our clients. In some cases, we're able to help them find different forms of debt. But as far as, I'll say, free money, as much of the PPP has been, there's less out there for small owners, and what I think you might be able to get, and Omar should be able to touch on this a little bit more, is there are some tax changes that can provide some additional relief in the form of NOL carrybacks that have been changed, and other ways to access, maybe not the best thing, but retirement funds that were set aside without the tax implications, penalties that would have occurred in the past.
Okay. Okay. Well, thank you very much. I really appreciate it.
Yeah, my pleasure, Donna.
Thanks,
Any
Greg.
other questions? Yep.
Okay, Omar, let's move on with the taxes, and then we can go back to the questions.
Okay. I'll start off by sharing my video here, and you guys let me know if I go in and out like Greg was doing, and then I'll shut down just to conserve some bandwidth. Let me share my screen here. Okay. All right. So I'll give you a general overview of what I'll talk about here, and I'll
Omar,
focus on.
we
Yes.
don't see your slides right now.
Oh, you don't see the slides?
No.
Can you see them?
No? Yes.
Wait.
Yeah.
There we go.
Okay, got it. Okay. So I'll go over just a general overview of what I'll talk about here. I got maybe 6 or 7 different topics, and if you have any questions, you can use the chat function, and afterwards I can definitely go into more in detail if you have questions at the end. The first thing I'll start with is the PPP tax impact. So we've talked a lot about PPP. So PPP is, there's going to be a lot around that with regard to deductions for PPP and forgiveness. Then I'll get into some year-end business tax planning, some tried and true methods that we use to lower our tax liabilities. And also I'll talk about some net loss carrybacks, which will give taxpayers a chance to possibly get some money back and get some cash flow on taxes already paid through the form of refunds. I'll talk about depreciation, tax credits, several tax credits, some year-end individual tax planning, and then I'll take a quick look at Biden's proposed tax plan, which is nobody knows if he'll be able to get it through or not. As we all know, there's 2 big Senate races down in Georgia that will impact whether or not Biden can get most of his tax plan through. So starting with the PPP, currently any funds used from the proceeds on expenses such as payroll and rent and utilities and mortgage interest and things like that, currently the IRS is saying that that's non-deductible. So you can imagine what type of problems that could cause if you get $100,000 of PPP money and you spent it all as directed on salaries, and all of a sudden at the end of the year, when it comes to time to look at your taxable income calculation, well, that income or those deductions for those wages, that 100,000 in wages that you paid, that is not deductible this year as it would have been in prior years. So the IRS is taking a position, they are getting a lot of pressure behind that. The industry group, the AICPA, is pressuring them to change this and make those deductions for salaries tax deductible once again. Make the other expenses related to PPP money also tax deductible, like rent and mortgage interest and utilities as well. So far, they haven't budged on it, but there is a move in Congress, which is probably where this is going to go. There is a move with with the both houses that are right now jockeying for the stimulus bill to try to include some provision in there that would make expenses related to PPP funds tax deductible, because this could cause quite a bit of trouble for some taxpayers. And the general theory behind it is once the loan is forgiven, the PPP loan is forgiven, the IRS's position is that tax-free money, any monies used for tax-free money should not be tax deductible, and that's the general rule. So if you have a municipal income, let's say you have a portfolio of muni bonds, and your muni bonds generated, let's say, $5,000 or $6,000 of income and interest income, and let's say you had some expenses related to that income, that is not deductible because it's related to that non-taxable municipal income. So the same theory holds here with the PPP. So as long as there's a reasonable expectation at this point that the PPP loan will be forgiven, even if at this point we don't know if some of those applications will be forgiven by year end, my sense is that most of them will be forgiven in the first quarter of 2021. So as long as there's a reasonable expectation, the IRS's guidance is that salaries paid from PPP proceeds are not deductible. So that's a big one that we should pay attention to at this time of year before now and the end of the year. And also some tried and true methods here. And this is true in a year where we don't expect taxes to increase in the next year, or we expect them to stay the same. Right now, based on our best guess, we don't know, because we don't know what's going on in the Senate, so we don't know what's going to happen. If the Senate races were already done and we knew that that Joe Biden was going to win, my advice to you would change. If I knew he was going to enact tax increases next year, which he's proposed to do, and we'll go over later, then I would change. I would say accelerate income. As you can see from the side, I'm saying defer income to 2021. If I knew that Joe Biden's plans were going to go through, and I knew the outcome of the Senate races, I would sing a different tune, so to speak. I would say take as much income into this year as you possibly can, but not knowing what's going to happen. I'm going to say defer income to 2021 to lower your tax liability, assuming that there may not be a change in the tax law next year. Maybe in the future, maybe there will be, maybe 2022, there may be something. Just consider opportunities to defer income to 2021. If you're on a cash basis, that would mean delaying collection of accounts receivable, rents, and payments for services. And also look for ways to accelerate deductions as well. So, prepay expenses, that sort of thing, order up as much as you can. If you're going to be ordering supplies for 2021 in the first quarter, maybe January, maybe you want to order up those supplies in the last 2 weeks of the year. So figure out a way to get as many deductions into 2020 as you can, and defer as much income to 2021 as you can. And that's generally the tried and true method of doing it. And there's also a benefit to that, as we'll see later, with the NOL carrybacks and getting your income as low as possible. And if you can, to actually generate a loss for 2020. There is a benefit to that. Also consider accounting method changes as well to reduce taxable income. There's an overall method change that you could do. Consider the accrual to cash conversion or the cash to accrual conversion. And usually you would look at your accounts receivable and your prepaid expenses and your accounts payable. Depending on the composition of those items, you take a look at that, and you know, a lot of times you could determine if you have a chance to really significantly reduce your income by looking at those items and switching either from accrual to cash or cash to accrual. Also look at depreciation. Maybe you've missed some depreciation in past years. Look at your fixed asset reports. Maybe there was a mistake there. You know, there's all types of things we can do by looking at the fixed assets schedule. If there was a mistake in a prior year, maybe we didn't get all the depreciation or amortization we could have gotten in a prior year. Now is a good time to scrub that fixed asset report and possibly find some extra deductions to reduce income. You can also look at prepaid payment liabilities, look at changing the way you account for those, and also how you deduct those. So there's ways to get more deductions from that, and with the change in accounting method. Look at your deferred costs. Same thing, your uniform capitalization method, which is inventory, basically inventory. Maybe there's a way we can correct methods that have resulted in some overcapitalization. So maybe we have too much inventory on the books, and there's a chance for us this year, by taking a detailed look at our methods in the past, maybe we correct some of those methods if they're incorrect, or change some of them, make an accounting method change, get some of that inventory off the books, and actually reduce our taxable income. So those are just a few methods we can use. We can also look at advance payments. We can look to defer advance payments for up to 1 year. Usually they would be included in income, but under accounting method changes, we can defer reporting them in income. Also accrued compensation, deduct amounts fixed and determinable that are paid within the first 2.5 months. So if you're looking to you're looking to actually make some payments in the first quarter of 2021, maybe you want to accelerate those payments and accrue that compensation. If you're on the accrual method of accounting, you could accrue those salaries, and those salaries would be deductible for 2020, would lower your taxable income, lower your taxes, and that's all permissible if they're paid within the first 2.5 months of 2021. Also, as I mentioned before, look at your inventory valuation. You want to take a close look at inventory. Do you have some bad inventory? Is there a chance to, pick up some deductions here on inventory, move it from the balance sheet to the income statement? So lots of times I'm working with clients at the end of the year. This is a good way to sort of to bring that taxable income down by looking at inventory, and looking at, is there a way we can change our method of accounting for inventory? Is there some bad inventory? And we can take advantage of that in many cases. And also look at your AR, of course, if you're on an accrual basis, take a look at that. If you got some bad debts, let's write those bad debts off as well. Let's lower the taxable income as much as we can. Net loss carrybacks, I mentioned those earlier, and this may apply to, I believe it's Donna Walsh had a question for Greg, where she said that the business has fallen off. If she was to generate a loss, a business loss for 2020, she would have an opportunity under the CARES Act to take that loss back 5 years and recuperate some of the taxes that she paid in prior years. So you'd be able to go back, Donna, and any business owner, if you have a net business loss in 2020, go back 5 years, and you can get a pretty quick refund for that. You can file what's called a Form 1045, and the refunds are supposed to be issued within 90 days. In all practicality, we've been dealing with this since the CARES Act came out. The IRS is a bit slow on issuing refunds, but technically they're supposed to issue refunds within 90 days of the tax filing deadline. So if you have a tax filing deadline of 4/15, they're supposed to issue that refund within 90 days. You generate a loss in 2020, you should be able to go back and get some refunds of taxes paid in prior years and get that money within 90 days. That's the intent of the CARES Act. And also, this is good for losses for 2019, and any losses for 2019, you want to file a refund claim by the end of this year. So there is a time sensitive filing that's required to get any refunds for the 2019 losses that you've generated. Depreciation, we always look at depreciation at the end of the year. Whether or not to take Section 179. For those who aren't familiar, Section 179 basically means that you're able to write off fixed assets. That would be equipment, that would be vehicles, trucks, anything used in the business. Usually it would be depreciated over 5, 7, 10, 15 years. You're able to depreciate that immediately in the first year of acquisition. And the max on that is $1,040,000. So you want to maximize your Section 179 deductions, and you also want to maximize your bonus depreciation deductions. The bonus is similar to Section 179, where the IRS allows taxpayers to deduct in full purchases of equipment, vehicles, and other items used in the business as fixed assets. So you get 100% depreciation, up through 2022, and then it starts to phase out. And you can see the chart there. It'll phase out down to roughly 20% by 2026, and then after that, there will be no more bonus depreciation. Bonus depreciation has been really good to taxpayers, and it's been around in one form or another since, I believe, 2001. Almost as long as I've been in the business. So bonus depreciation is a really good tool to manage your tax liability. Depreciation on SUVs. If you're thinking about getting an SUV between now and the end of the year, you can write off, $25,000 using Section 179. Just make sure you buy that vehicle before 12/31. You can also do 100% of bonus depreciation if that vehicle is over 6,000 pounds. So that's a real good deal. Some SUVs weigh that much, and you can get 100% write-off. So if it costs 60 or 70 grand, you go ahead and write the whole thing off in the first year. And some items that my clients use that would be deemed, transportation vehicles or carrying around products and things like that, there are no limits on those. You can write those off 100%. So it doesn't matter how much they weigh, as long as they're used in the business for, transporting either people or products and things like that. You can go ahead and write off 100% of those items as well. Luxury autos and listed autos, the IRS has this term luxury auto. Basically, it's any automobile that costs more than, roughly $18,000. So that's basically all automobiles are considered luxury. And there's a limit on how much you can deduct. So the first year you can do bonus depreciation of $18,100. The catch here is that when you file your return, make sure your accountant or CPA makes an election to depreciate that vehicle after the first year. So let's say that vehicle costs $40,000 and you took an $18,000 deduction. Well, you still have $22,000 left to depreciate on that vehicle. But if you don't make an election to depreciate the vehicle after year one, then you have to wait until 5 years to take the rest of that $22,000 deduction, which is painful to say the least. But if you make an election, this is something that taxpayers don't know anything about, and but just mention it maybe to your CPA, because if they blow that election, then we're looking at waiting 5 years at the end of the useful life of the vehicle to depreciate the remainder of the $22,000 of cost. So that could be a costly mistake. So just maybe mention that to your preparers, your tax preparers. This is a big one right here. A qualified improvement property, mainly leasehold improvements. When the tax return or the Tax Act changed in 2017, 18, when Trump first came into office in his early days, there was a mistake made in the law with the new tax law. Leasehold improvements, which have generally been fully deductible under bonus depreciation. So let's say you have a business and you make some leasehold improvements. Usually you would get a 15-year life, but the tax law changed in 17 and 18, made it 39-year property and made it not eligible for 100% bonus depreciation, full write-off in the first year. So the IRS under the CARES Act came back and changed that to taxpayers' benefit, and this has really been a boon for taxpayers. I've filed many of these refund claims because for 2018 and 2019, now we can go back, and in 2020 as well, we can go back for leasehold improvements and other so-called qualified improvement property, and we can categorize it as 15-year property, and we can write off 100% of it. For instance, I was able to get a client, $100,000 refund. They made a bunch of leasehold improvements in 2018. At that time, we could not use 100% depreciation because of an error in the tax law. When the CARES Act came out this spring, we were able to go back and now consider this 15-year property, which meant it was now eligible for 100% bonus depreciation, first year depreciation. So we went ahead and did that, and we got massive claims for refunds under this provision here. So really, if you've done any leasehold improvements over the last several years since 18, 19 or 20, really consider this. Most CPAs will know, all CPAs should know about this. Just make sure you bring it to someone's attention if you've done something in 18 or 19 and you didn't get that benefit of the full write-off, because then now you want to go back, file a refund claim and get that money back, reduce your taxes quite a bit. So the difference is you're writing off 100% of leasehold improvements in the first year you put it in service versus depreciating them over 39 years. So that's a big major difference in deductions, tax deductions, and tax liability. So this is a big one. Also, Section 179 for real property is still available. This was part of the law change in 17. So basically, you can write off a roof, HVAC or fire protection, alarm and security systems. Usually that would be deductible over usually 27.5 for residential and 39 for commercial rentals. Now you can go ahead and write that off in the first year. So that's a big area ripe with deductions there for real property. And at one time, the IRS would not allow Section 179 for real property. This is a good one here. Under the CARES Act, you can get refunds of AMT credits for corporations. So this would be for C corporations, not for pass-throughs such as LLCs and partnerships and S corps. This is strictly for corporations. There's a new rule under the CARES Act that says any unused AMT credits can now be you can now file a claim for those and go back and get them. So let's say you were a C corporation and you paid AMT tax in a prior year. Well, you get a credit for that. And for those who don't know what AMT is, it's alternative minimum tax. Basically, it's a way for the IRS to find a way to, in its rules, even when your income is low, to find a way to charge you a minimum tax. So corporations that pay this minimum tax, now you can go back and get a refund for all unused AMT credits. Fastest way to do it is on a tentative refund claim on the form 1139. And again, this is time sensitive. Make sure you file this by the end of the year. Now we'll go through some tax credits. There's an employee retention credit out there. And this is for companies that did not receive PPP. So if a company did not receive PPP for whatever reason, maybe they were too large, or maybe they didn't qualify, you know, they can still receive an employee retention credit. So that basically means during the coronavirus, when pandemic, when things were really bad, things are bad, right now for some businesses. To the extent you hold on to employees and you don't let them go, you're able to get a $5,000 up to $5,000 in credit for every $10,000 in wages, and that's between March 12th and December 31st, and it's a refundable credit as well. And my sense is that since we're still in the middle of a pandemic, I'm thinking that the first quarter, at least, maybe the first 6 months of 2021, at some point, I believe Congress will change some of the rules and extend some of these benefits here, especially those related to COVID-19 relief. So I think this one will be extended as we're in the middle of a shutdown right now. That'll probably go past January 1st. And the last day for these credits is generally December 31st, 2020. The CARES Act also has a credit, and Greg mentioned this, for sick leave for up to 80 hours or 10 days. Basically, Uncle Sam pays this. So if you have a business, and you may have heard this already, if you have a business and someone has to quarantine, or someone is sick with COVID, up to 80 hours, you could pay them. And essentially, when you pay them, you're paying out of your pocket, of course, but the IRS will give you a credit on payroll taxes for 100% of the wages you pay, up to $5,110. So this is actually a good deal here. And for some people, some businesses actually missed this year. I had a client just call me the other day and said that, hey, I had a couple of people, I had about 6 people I did COVID pay for. He runs a daycare. People were either quarantining or they caught COVID in the summer. And even up to now, I've been paying them. What about this credit? And I said, yeah, oh, absolutely, you can get the credit, even if it's for a past period. So if you missed it and it was maybe in the summer or in the spring, you can go back and take care of this and get the credit still. Just go through your payroll companies, ADP, Paychecks, or whatever payroll company you use, and they'll guide you through how to get this if you missed this. But this is another credit that's through the end of the year that I suspect will be around in some shape or form in 2021. But we will see what Congress comes up with in terms of relief here in the next week or so. So the credit for wages paid up to 10 days or 80 hours, as mentioned, $511 per day. And family leave. So there's an additional credit for family leave up to 10 weeks. So if a person exhausts the 80 hours, now it's, they could do extended family leave up to 10 weeks for 2/3 of pay, or $200 a day, $10,000 total refundable. Again, this will be a refund the company pays, and then the IRS refunds payroll taxes. Now, let's say you don't have enough money, you don't pay enough payroll taxes to cover someone's salary. So let's say, just for instance, someone's salary was, $5,000, and you didn't have enough payroll taxes to offset that. Then you could ask for an advance on that. You can ask for an advance, and it's a form 7200. You ask for an advance, and you could easily get that money from the IRS within, I believe it took my client maybe 3 weeks to get an advance. So they're very helpful with that. Some other credits that are useful, R&D credits, and basically you'll look at your wages, cost of supplies, contract research expenses. You can offset payroll taxes if you have no income tax. So you can reduce your payroll taxes if you have no income tax. So that's a very good deal. It's not as hard as most people think to get the research and development tax credit. We work with a number of firms. One is Alliant to help our clients, get the maximum research and development tax credit. If you're interested, if you have a business you think that may be eligible for that, well, please reach out. We do have some third parties that we could refer you to that could help you, and there's no charge for that service unless you engage them. Work opportunity credits this is often one that's missed. There's opportunity here in the name, work opportunity credit. Some people call it the WOTC, but it's up to $9,600 per employee. That's a big credit there. And essentially a business will get credit for hiring employees from targeted groups. So this would be veterans, SSI recipients, long-term unemployed, SNAP recipients, even ex-felons, and maybe 4 or 5 other different categories that you could hire from and get up to $9,600 per employee. So a lot of businesses are hiring these people and don't even know it, that they're leaving a $9,600 credit per person, per employee on the table. So don't leave that money on the table. Be sure to think about the WOTC, the work opportunity tax credit, the next time you hire somebody. And usually you have to go through a state agency. You'll collect, you'll collect a disclosure from the employee, and you'll have to go through a state agency, submit this information, and they'll certify the credit, which is actually a federal tax credit. But many times you go through a state agency to make this actually work. But anytime you hire somebody, really think about who you're hiring. And if you're hiring someone from, I think it's 9 different groups, you will be eligible for the work opportunity credit. Very big credit and often missed. And now let's go through some individual year-end tax planning. One of the things you could do is, if you don't itemize, there is a special $300 charitable donation. That's what we call above the line. So if you don't itemize, you can at least get a $300 charitable donation on your 2020 tax return. But if you do itemize, or you're close to itemizing, consider making charitable donations before the end of December, before the last day of the year. And if you really want to maximize those donations, use what we call a donor advised fund. I always advise my clients to use the donor advised funds. We're big on them, and essentially what they are is you can bunch charity together. It's been really difficult since the tax law changed a few years ago to itemize, whereas most people used to itemize if they had a mortgage, if they pay real estate taxes, that sort of thing. Now it's a little bit harder. If you're married, you automatically get $24,000, and on top of that, your taxes are now reduced down to $10,000 with the 17 change, the TCJA. Now you can deduct no more than $10,000 in real estate and state and local taxes. So that hampers a lot of married filers, married joint filers. So one way to get around this and to get the itemized deductions is to do these donor advised funds. And let's say you contribute $20,000 to a donor advised fund, you get that full $20,000 for 2020. But you don't have to distribute it to charities in 2020. You can do it whenever you want. Fidelity has donor advised funds. Most financial advisors have them. Essentially, you contribute the money now before year end, you get the tax deduction, lowers your tax, and then you can give away the money to your favorite charity in 2021, 22, 23, whenever you want to give it away. Also, try to maximize your retirement savings. Contribute the max to your 401k, which is 19.5 for 2020. And if you're over 50, you can do another 6,500. So contribute as much as you can there, because as many of you know, the more you contribute to your 401k, the larger your nest egg will be, for one, and secondly, it also reduces your taxable income. So it's sort of deferred. Anything that goes into any salary that you defer through a 401k elected deferral, of course, is not taxed now, which reduces your taxable income. It's only taxed when you take it out when you're retired. Contribute to max to any set plans, and those are plans for businesses or self-employeds, and also any IRAs as well. Some IRAs will be deductible. It just depends on whether or not you are a part of a retirement plan at work. If you're married, whether or not your wife or husband is a part of a retirement plan. And also it depends on your income as well. So that's what determines whether or not a regular IRA would be deductible. You can avoid required minimum distributions for 2020 as part of the Secure Act that came out not too long ago. Now taxpayers do not have to take retirement distributions in 2020. I'm sorry, I believe that was the CARES Act there, but it's some relief. So if you are one of those who, or if your parents take required minimum distributions from their IRAs or their 401ks or their employer-sponsored retirement plans, be sure to, if you don't need the money for 2020 and you want it to grow, you don't have to take a retirement minimum distribution. Also, this time of year, you want to work with your financial advisor and your CPAs to do tax loss harvesting. So if you have some gains, capital gains, you want to look and see if you can offset them with some losses. So if you have losses in your portfolio, go ahead and look to realize those losses and get your capital gains down as low as you can to reduce your tax liability. Be careful not to go too far because the IRS limits individual capital losses to no more than $3,000 per year. Anything over that, you have to carry it forward indefinitely. Also consider taking, this is a really nice part of the new law, consider taking COVID-related distributions from your retirement accounts for cash flow purposes. So let's say you had a tough year and you have some money saved up and you need some money and you're finding it hard to get money from somewhere. Well, you can actually go ahead and get a distribution. We'll call it a COVID-related distribution from your IRA or from your 401k, employer-sponsored plan. The 10% penalty is waived. And also you could do up to $100,000. And the big benefit of it is you take it into income over 3 years. So, if you took 100 grand, you take roughly 33,000 into income over 3 years. If you didn't want to take it into income, you could actually pay it back within that 3-year period. So you go ahead and pay that money back within the 3 years. It gets back to working again for you and it builds your nest egg again. You used it for an emergency, you put it back, and now there's no tax on it. So you can consider that as well. So this is a real nice deal. I had a client who was being pressured by the IRS. They had a pretty big tax bill. They had a pretty good year in the market, and didn't have the cash available at the time and decided to take advantage of this. There are some stipulations on it. You have to be diagnosed with COVID, or a spouse or dependent or family member has to be diagnosed with COVID. Also, if you're quarantined, furloughed, or laid off, or if your income was reduced or hours reduced, or anybody in your, the rules are pretty general. So anybody in your family, if they were, laid off, or hours reduced, income reduced, or furloughed, you could actually get this benefit here. Take 100 grand, taking an income over 3 years, or actually pay it back within 3 years and have no income tax. And usually when you take money out of these accounts and you're less than 59 and a half years old, there's a 10% penalty. With this, there is no 10% penalty. Very good deal. So now I'll go over some of Biden's plans, which nobody knows for sure if he's going to get all these through or if he's really serious about doing all this stuff. Some of this stuff is really draconian and would really be going quite far, but we'll see. And right now we don't know if the Senate flips and those 2 Senate seats down And I'm not one much for politics, but a lot of people are watching this in the tax world, and a lot of sophisticated taxpayers are watching this too. Depending on what happens in Georgia, if the control of the Senate goes to the Democrats, they will now control both the House and the Senate. And if Biden wants to go ahead and raise taxes, he will have basically a free path to do that. If it stays Republican or if it's pretty close there, that will be much harder to do. So nobody knows at this time, and the sad thing about it is we won't know until January 5th, I believe. So if they had, if the runoffs were in December, we would know something, but now we don't know anything. So we're just going based on what's out there right now. And so this is Biden's plan: return the top tax rate to 39.6, which it was under the years of Obama-Biden administration. Right now it's 37%, so that's a 2.6% uptick on the top rate. Tax capital gains and dividends at 39.6% for taxpayers over $1 million. Right now, the tax rate on dividends and capital gains is the top rate is 23.8%, 20% long-term capital gains plus 3.8% surtax as well. Eliminate the 20% pass-through deductions for taxpayers with income above $400,000. This would be a big one. So right now, for all S corp owners, for all LLC owners, for partnership owners, your income from that partnership. Let's say you made $100,000 and you own an S corp, you made $100,000. Right now, under current law, all things being equal, you would be able to deduct 20 from that, so you'd only essentially be paying tax on 80,000. So that's pretty huge, and that came with the tax law changes in 17. So now Biden's plan is for anyone that makes over 400 to remove that 20% pass-through deduction, and that would make taxpayers making over 400,000 pay 100% on all of their S corp and partnership and LLC income versus paying 80% on it. So that's a big change. Here's one I find very tough here. This is an additional 12.4 Social Security tax on employees earning more than 400,000. So right now, the current threshold, I believe, was 137 for Social Security for 2020. So once a person reaches, 137,000 or so, I think it's going to go up a little bit in 2021 for inflation. But once they reach that point, they don't pay any more Social Security tax. But under Biden's plan, between 137 and 400,000, there's like a donut hole, no Social Security tax for the employee. But once the person gets over, if it's a high earner and they make more than 400,000, he would then hit their salary for basically another 12.4%, which seems kind of ludicrous to me. That would be really ridiculous, but that's in his plan. For higher income earners, that would really hurt quite a bit. He plans to reduce itemized deductions with the phase out for high earners. Those are for earners making quite a bit of money. All itemized deductions would not be deductible. He would phase them out for those high earners. There'd be an increase to the child tax credit of $3,000 per child, and any child under 6 years old, there would be a credit of $3,600. This is a pretty good deal here. Expand the child and dependent care credit from $3,000 currently max up to $8,000, and there would be a first-time home buyer credit of $15,000, which would be pretty significant. And from what I understand, that somehow would be paid at the time of closing. There was a first-time home buyer credit some years ago, and in order to get that credit, you would have to file your tax return to get the credit. But under this program here, under this proposal here, Biden is somehow trying to get that money out to homeowners when they purchase their property. I'm not sure the mechanics on how that would work. So those are Biden's proposals. Also, there's an increase in the corporate tax rate. He wants to increase from 21 to 28%. When our tax rate went down to 21%, before that, the corporate tax rate, the max was 35. That made us much more competitive with foreign countries, and it drew a lot of businesses to the U.S. shores, brought a lot of businesses home that were doing business overseas because of our relatively high structure, corporate income tax structure for corps. So this would raise it back up a little bit. It would sort of put us in the middle of the pack, but that is quite a substantial increase right there. There would be also a new minimum tax for corps. I mentioned earlier that there is a refund opportunity for AMT tax credits out there. And the reason that's there is because when the law changed in 17, the TCJA, there was no more minimum tax for corps. So there were unused minimum tax credits. Hence, under the new laws here, you have an opportunity to go back and get those as refunds. Biden would come along. He's proposing a new minimum tax for corps, reinstating the minimum tax. There's a couple of things here with the estate taxes. At the current level here, the estate tax exemption is 11.5 million for each individual. So for a married couple, that would be roughly 23 million. So that means if someone has an estate under if a couple has an estate under 23 million, essentially they wouldn't pay any estate tax. Well, at one time it was at 3.5 million, so Biden proposes to bring it back to 3.5. So any, per person, so any couple with more than $7 million would now be hit with an estate tax, and the rate would go from 40 back up to 45% where it was years ago. And there would be an elimination of the tax-free step-up in basis at death for estates. Essentially what that means is, let's say someone had $20 million in assets, and they passed them all on to family members. Let's say this is a couple, so they didn't pay any estate tax, but they had 20 million in assets. They were under the threshold for combined estates. They passed it on to their children. Their children then sold let's say it's stocks and bonds. They sold the stocks and bonds the next day for 20 million, which was the value at the date of death. They get a step up in basis. So their basis or their cost when they go to sell it is now 20 million, because that's what it was when their parents passed it on to them at death. So they pay no income tax. No income tax when they sell those stocks. It's free and clear. Under Biden's plan, he would eliminate that tax-free step-up in basis at death. So that's Biden's plan there. That is my presentation. Or if there are any questions, I'll be glad to take questions. Please feel free to fire away.
Yeah, feel free to unmute yourself. Okay, there's one question, Omar, in chat.
Yes. Oh, there's one question in chat?
Yeah.
Okay. Let's see here.
Omar, the question is, will 5-year
I think-
depreciation disappear and go back to 7 years?
I'm sorry, what's that, Greg?
The question is, will the 5-year depreciation disappear and go back to 7-year?
The 5-year depreciation, I'm not sure what that means, the 5-year depreciation. It's 5 years for vehicles and 7 years for equipment. So I'm not sure I'm not sure. Those the useful life of something that's 5 years usually doesn't change. So I would say no, it would not change.
So he says for new farm equipment, rate is 5%.
For new farm equipment. So in general, farm equipment, I haven't dealt with farms in a while. I can look that up, but generally farm equipment enjoys very favorable tax depreciation. 5%, I would have to look that up. I'm not sure what that is actually. But I can say in general, it's very favorable for farms, as the IRS has made it easier for farms to manage their tax liabilities with depreciation.
Omar, can you go to chat?
That question, I'm sorry, what'd you say?
Can you go to chat? We have a couple of questions there.
Yes, I'm in chats now.
Okay. So you see
Yeah.
Dave's
So
question?
Yeah, if you receive a PPP loan and highly profitable in 2020, does that have any impact on forgiveness? I don't believe it does. I don't believe it does. So forgiveness is a mechanical calculation that's based on money that was spent, number of employees, whether they increased or decreased during the years. A profit well,
Let me
okay,
add something
maybe I'm
to that,
looking at
Omar.
this. Yeah.
Omar, let me-
Go
let
ahead,
me
Greg.
jump
I was
in
going to
there.
say
So,
something else.
yeah, we've talked about this, and this is somewhat under the Biden administration. We're not sure how that look back is going to be on the forgiveness. Omar is correct. The calculation is the calculation. The question is, if you've been exceedingly profitable during the year, is there going to be some question as the ultimate need of that loan early on, which was a lot of debate when the program first rolled out. If you have a high loan, and high in this case defined by more than $2 million, we suspect there will be a lot of scrutiny on that, both on the calculation and then I'll say the ultimate eligibility, which could lead to impact the forgiveness. The answer is right now it doesn't, but we're not sure how it's going to be treated.
I saw there was a question on should one delay applying for PPP forgiveness until 2021, and so I'm assuming this is about the deductions for proceeds from the PPP loans spent on salaries that are currently non-deductible. It doesn't matter when you apply if there is a reasonable expectation that your PPP loan will be forgiven. If you think it's reasonable to expect that, then the deductions for salaries paid for with PPP funds at this point would not be deductible. So it doesn't matter if you wait to 2021. And it doesn't matter if your loan's approved either. Your forgiveness application is approved. Doesn't matter.
Yes, this is Earl. I was just wondering, does the PPP tax impact applies for your grants too?
Grants are generally, to my understanding, are these PA grants?
Yes.
PA grants, what were they used for? Were they used to purchase fixed assets?
Used for the business of just used for the money that was purchased for like for supplies and rent and utilities and all the things applied to the business.
So more operating expenses, not so much fixed assets.
Yes. Mm-hmm.
Okay. Yeah. So that would generally be taxable. Grants would be generally taxable, but the expenses in this case would be deductible as well.
Okay.
The expenses would be deductible if the grant is taxable. Expenses deductible. PPP. We're saying that it's going to be forgiven, and if it's forgiven, then the IRS rule right now is that the forgiven amount of the PPP loan will not be taxable. So in that case, because you picked up tax-free income, you'll also not be able to deduct the expenses at this particular point in time related to the PPP use of funds.
Okay, so they both,
So the key is,
so the grant, go ahead.
yeah, the key is if the income, so when a loan is forgiven, it becomes an income statement item at that point. And the PPP money that's forgiven is in the Internal Revenue Code is specifically mentioned as non-taxable. So because it's non-taxable, the IRS is saying, well, any proceeds from that you use to pay your employees or you pay rent with, that's also non-taxable. That's just an old IRS construct theory that's been around for some time. There's a lot of pressure on the IRS to change that, and we may get either partial deductions or full deductions. And we'll know that, we may not know soon, but we'll probably know by the time we file tax returns in the spring.
Okay, that's just at this time though, right? That there's no
That's
non.
That's correct. At this particular time, that's the IRS's express wishes. They've put out guidance on that, and they have met with a ton of backlash from that, from taxpayers, because a lot of small businesses are thinking, wait a minute, I went out here and I got a loan, and you guys are taxing me on it. This was supposed to help me. How's that supposed to help me? So we'll see how that works out. I figured that the IRS is gonna come back on their position, and my guess is that they will either give a partial deduction or full deduction. We'll see.
Okay.
Lynn, did you have a question? I'm sorry, Earl. I'm sorry. Did you have another question?
No, I was just trying to see the difference between that, because it's basically the grant. It's like you said, it's non-taxable, right? At this time.
The PPP is non-taxable. My understanding is the grant is taxable, and unless you use it for, there are some grants. It just depends on what the grant is used for. If the grant is used for to buy equipment, then what we do is we generally will reduce the cost of equipment, and we will have less depreciation deduction for it. But my understanding, if the grants are usually taxable income, and in that case, then any expenses, you paid office expenses, you bought supplies, you could go ahead and take those deductions, as opposed to PPP, which is just the opposite at this point.
Okay, and you said something about the as far as the write-off, the depreciation for like if you have a vehicle that's over 6,000 pounds, that's 100% write-off on that vehicle, like a bus, for instance,
Yes, that's right. 100% write-off on vehicles over 6,000 pounds. That's correct.
So do you get all of that when you get that write-off? Can you get all of that? Can you write all of that off for what you pay for the vehicle, or is that something that they're just taking from there? Do you get that?
Yeah, you can write it all off. So let's say you paid $75,000 for a vehicle that weighs over 6,000 pounds, and when you file your tax return, you're gonna write off the full $70,000 of that vehicle in year one.
Okay. Now, what if you pay less than the vehicle, but the vehicle is worth more than what it is that you paid for? Do you have to? I mean, how does that work?
It's only the amount paid or financed. So it's only cash out of pocket or what was financed. That's all you can deduct. You can't deduct anything more than that.
Okay, I appreciate that.
Okay, we have to move on with the other questions.
Okay, let's see here. Don't have a 401k at work. My wife has a 401k. Can I contribute to additional? Yeah, so if you have, so you and your wife, this question here says, someone has a 401k, the wife has a 401k, and she contributes. They're covered by a plan. Can they contribute to a traditional IRA and get a deduction? It depends. If your income's over 123,000, your adjusted gross income, no deduction. If your income's between, let's say, 90,000 and 123,000, you get a partial deduction. If your income's below a certain threshold, let's say 90,000, you get a full deduction for your IRA. So it just depends on your income. In this case, you're covered by a retirement plan, and now it's going to depend on your adjusted gross income, whether or not you can deduct the IRA fully or not. But in general, if it's above 120, let's say 25,000, no deduction. Okay, so this next question is someone self-employed. They have a daycare business. They have no employees, and they took a PPP loan, and it's forgiven. You would not be responsible for taxes on that. So if someone's self-employed, I don't know if this person is, so I'm going to assume that this person is what's called a sole proprietor, Schedule C filer, and they're self-employed, so they have no employees. They took PPP and it's forgiven. Would you not be responsible for taxes on that? Apparently you would be. Same as if you had employees. So I'm assuming this person is a sole proprietor, files a Schedule C. In this case, they wouldn't need employees. They could qualify for PPP without having employees. And the same rules would apply as well as to the taxability of the PPP money as it would as if you had employees.
I see someone raising hand, so you can unmute yourself and ask your question.
Omar, I have a question, and it's industry specific because I'm in real estate. But in regards to relief for can you hear me?
Yes, I can hear you, Dawn.
Okay. In regards to relief for landlords, if you could predict the future, what would the details of that package, or what might you think the details of that package might be?
Yeah, for landlords. So are you talking about? So are we saying that tenants aren't going to be able to pay, and landlords are going to go without collecting rent, right?
Yes. Yes.
Is that your? Okay, so you're going to, as a landlord would incur losses. I don't think there will be anything special besides the NOL carryback at this point. So let's say you know receipts were down, rents were very low. You still had tons of depreciation on your building. You had other expenses for utilities, things like that. So you generated a loss. Now you go ahead and take that loss and you carry it back 5 years. And if you pay tax, during those years, you will get a refund. So that's the provision, the NOL carryback.
Okay.
I don't suspect there'll be anything more than that. Yeah, no problem. Thank you. Did Lynn have a question? I saw Lynn was trying to get a question off. Are you still there, Lynn? I see a question here. Do we need to complete the PPP forgiveness paperwork by end of 2020? No, you do not. Greg, do you know that the time period for that? Is it 10 months after your coverage period ends? I don't believe I'm sure you don't have to do it before the end of 2020.
Sorry,
that was a question from Vincent.
No, you don't have to, and I think it's 10. I think you're right. I think it is 10 months after the end of your 6-month forgiveness your
period,
measurement period.
Mm-hmm. Okay. Regarding daycare expenses, what portion is deductible? The current child tax credit is for 2020 is slated to be $2,000 per child. Regarding daycare expenses, you can deduct based on your income. It's a sliding scale, but the most You can, I see the question says, what portion is deductible? But I think the correct question would be, what would be the credit for dependent care expenses? Generally, it's 20% of the amount you spend up to $3,000 is the max. And under Biden, he's proposing to increase that to $8,000. And the current child tax credit, which is different from the dependent care credit, is currently $2,000. That was a question from Ed. Carbon credits. At this point, I do not have any information on carbon credits. But if you email me, I can get that information. I could look it up and research it. Do you have anything on carbon credits, Greg?
No, I don't have.
I don't have anything. So Marcy,
No.
yeah, Marcy, if you could send me, if you can send me an email, my email is on the presentation, othrower@wilkiecpa.com. I will gladly research that question for you.
Any other questions? Please remember to fill out the evaluation forms that I shared through chat. We really appreciate your feedback. Any other question before
And
we
if
close?
anyone hasn't, yeah, if anyone has any questions after this, they could email me or Greg.
And Omar and Greg, can you also share your contact information in chat? So if anyone has any questions.
Yeah, I will.
Great idea.
Yep.
We'll do that right now.
Does
One
everyone
more
see
question came
my,
through here.
did mine go through, Greg? I don't think it went through.
No, I don't see yours, Omar.
What am I doing wrong here on the chat?
You have it to everyone?
Let's see here. To everyone publicly. Okay. Boy, why did what happen? It's not working. Okay. Nothing. Huh.
No?
Greg, can you drop that in here for me?
I was just
I'm not
gonna do
sure what I'm
that,
doing
yeah.
wrong. Yeah. I'll throw her at Wilkie.
Yeah, I'll put your email in there.
Thanks.
Yep.
Okay, then. Thanks for joining us and happy holidays. Enjoy the snow out there. Thank you, Greg. Thank you, Omar.
Thanks
Thank you
All right,
for your time.
Our pleasure. Thanks for coordinating
Thank
this.
And again, we
Thank
will
you.
email the
Appreciate
slides.
it.
We will email the slides and the
Yes.
recording. Thank you, everyone.
Yes. Thank you.